Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Stephen Ricchiuto. He is the managing director and chief economist with Mizuho Americas to discuss trends in the US dollar and what to expect for 2022 when we put this all together with FX. Stephen, it's great to see you again. Welcome back to Trade Talks.
Oh, it's my pleasure. Thanks for having me back, Jill.
And Stephen, let's do a quick review here. How did 2021 play out? What were some of the trends that you saw, and were there any surprises?
Well, there was a big surprise, actually. In the early part of the year, we had been looking for the dollar to break below some of its recent trend lines. In particular, one measure we look at a lot, which is DXY, which is a Bloomberg tag, showed the dollar actually losing a lot of momentum, and we expected it would continue to do that. However, very early in the year, it began to reverse direction very, very quickly. And then around June, as the perceptions of monetary policy changed, we changed our view for a stronger currency. And that's been our view throughout this entire environment here. And we think going into 2022, the dollar is going to continue to appreciate against not only the euro, but also against the yen. Whether it appreciates against some of the commodity currencies is going to be a little bit more interesting because they're typically biased down because of the stronger dollar reflects lower commodity prices typically. But in an environment where there's a shortage of supply of commodities in general, we may see the commodity currencies hold in much better than we would normally expect in a stronger dollar environment.
So, Stephen, when we put all those things together as you look into 2022, what could potentially be the risk to that thesis?
Well, I think there's two things to worry about. One is how much do we overshoot? Currency markets tend to go into momentum. As I said, when we were going into the beginning part of this year, there was a strong downward tilt in the dollar, and we pushed through some very, very critical technical levels very early in the year. And then instead of continuing that, we reversed directions. I have a sense that this year we're going to do the same thing. We're going to overshoot to the upside in the dollar before people begin to transit out of the concerns that the dollar is what's driving the dollar begins to reverse. In particular, what's driving the dollar is the call on monetary policy. There's a lot of discussion about what the Fed needs to do and what the Fed will do going forward into 2022. And this against the backdrop of what's happening in other central banks, where clearly more accommodative monetary policies are being prescribed. There's a divergence that's happening between the dollar and other currencies because central bank behavior is diverging. And I think that's going to dominate the first part of the year. As the year progresses, we're going to see some of the inflation concern, which is driving the expectations of monetary policy, begin to abate. And then I think after we get through the first quarter of this year, we'll be looking for the currency to reverse a lot of the downward trajectory. But in the first couple of months, it's all upside. Then we begin to look for a sharp reversal out throughout the balance of 2022.
And Stephen, we start to see some central banks increase their interest rates. Is the U.S. behind the curve on that, and we should be at that point? Or do we still need to be a little bit cautious here and see how this plays out as we think about the inflation story, employment story, supply chain issues, COVID?
Well, keep in mind that the central banks that have moved are not the central banks that are dominant in terms of the currency market. They tend to not be the major industrialized countries, or China for that matter. When you look at Japan, you look at Europe, you look at China, there is no evidence whatsoever that any of these areas are going to be tightening monetary policy. And therefore, the behavior of the currency is going to specifically follow the behavior of the Fed. And that's what we think dominates over the first part of the year, where expectations about monetary policy tightening develop. And then as we go further into the years, people begin to realize, well, the market's probably gone too far in terms of that expectation. Then we're going to see a reversal of the thought process on the Fed. And with that will come a reversal in the currency.
And Stephen, to wrap up here, in the course of your career, have you ever seen it where the dollar, even stocks and bonds and so forth, are so married to what the Fed is doing as much as we've seen in the past 2 to 3 years? It feels as if some of the moves can be a bit exasperated here.
Well, I'm much older than you, and I'm much older than I think a lot of your viewers. So I do remember times when that has occurred. But in the very, very near term, you've got to remember that this Federal Reserve has been very, very predictable, and they've been very, very telegraphing what they were going to do. And it's only the developments where they still feel they're being predictable and they're telegraphing, but expectations are getting ahead of them because the data is moving ahead of them. And therefore, they're being perceived as falling a little bit behind the curve, and therefore there's a catch up. And that's really the reason why. But at transition points, you often see them going directly against what's happening in terms of the market sentiment versus the Fed policy sentiment.
All right, Stephen, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.